Good morning and welcome to Market Cafe. You're on ET now with me, Lisa Fernandez, and with me is Shreyansi Singh. Very good morning to you, Shreyansi. And during the course of the next 1 hour, we take you through what's largely coming in from the international market, as also keep you well prepared for the domestic market ahead with the cues, announcement, brokerages as well. Let's start with the international handover coming in. Shreyansi, you're all smiles. Looks like it's a very strong handover coming in from the market, especially after the FOMC meet outcome.
Absolutely, you got that right. It was all smiles for me as well as the market, because the Dow jumped by 1.4% during the main trading session to close above 37,000 for the first time and broke its previous closing high from January 2022. When you look at the S&P 500, that also added 1.37%, and that also finished above 4,700 for the first time since January 2022. Now, when you look at the Nasdaq Composite, that gained 1.38%. The three major averages all rose to new 52-week highs. And when you look at the reason for that, the FOMC kept interest rates unchanged in a range between 5.25% and 5.5%. This was, of course, in line with Wall Street's expectations. But a trigger regardless, market sentiment was bored after policymakers also penciled in 3 rate cuts next year. Investors will be keeping an eye on economic data tomorrow as well. So when you look at data coming in tomorrow, you've got weekly jobless claims, you've got November's retail sales and imports data that are also due that morning, as well as October's business inventories report. So still a lot of data for the market to sort of cheer on, Lisa.
Right, so that's the market, the handover coming in, pretty robust handover coming in there. But let's look at impact did it have even on the crude oil prices as well. It rose more than 1%, and this was on the back of 2 reasons. It was the much bigger than expected weekly withdrawal from US crude storage, as well as the Fed Reserve, which indicated 3 rate cuts, which is coming next year. Well, talking about the crude inventory level, US Energy Information Administration said that the energy firms, they pulled out 4.3 million barrels of crude from stockpiles during the week ended December 8, and this was much larger than the Reuters poll of 7 lakh barrel withdrawal. So quite a significant surprise coming in there. And if we see the crude oil prices, they've been quite volatile, because on Tuesday both the Brent as well as WTI crude, they closed at their lowest level since 27 June, and this was largely on the fears that a slight rise in inflation last month, that would mean the Fed Reserve is not ready to let up on their rates yet. But the Fed eased those worries on Wednesday. It held the rate steady, indicating rate cuts were coming in 2024, because higher interest rates, that could slow down demand and that could put pressure on the oil prices. And also let me mark the OPEC latest report, which said that they remain cautiously optimistic about the 2024 oil market fundamentals, and they blame the exaggerated concerns about the demand for a recent drop in prices. So if I look at the oil prices now, the WTI crude, that is about that $70 per barrel. It was just $69 recently, and now it has come back to those levels. And Brent crude is also 0.8% higher. It's at $74 per barrel. And if I look at gold also, that climbed, and it's about $2,000 per ounce. And this is especially as the treasury yields tumbled and even the dollar weakened. The dollar index, that is at around 102 level. Shreyansi. So that's largely what's the impact that happened across crude as well as the other commodities.
Right, and like I said, there's also still a lot of events that we still have to look out for. So you've got US initial jobless claims, you've got a UK Bank of England rate decision, you've got the Eurozone ECB rate decision as well. So do keep an eye out for that today. Now, in terms of corporate action, there's Jindal Saw that is mulling a fundraise proposal. So that counter will remain in focus, as well as EMS, because the lock-in opens on 4.1% equity for that one. And it's also the last date for eligibility for buyback for Somani, so that counter as well will remain in focus. Now, in terms of IPO action, there's of course Inox CVA that opens for subscription today, so that will remain in focus. And in terms of other events, you've also got European Council meet, you've got an annual press conference as well, and also the National Energy Conservation 2023 event. So all of those events will also remain in focus.
Right, and let's look at some important global stories. Of course, the FOMC outcome, as expected, the US Federal Reserve, they kept the policy rates unchanged at 5.25% to 5.50%, and this is for the third straight meeting. But looking at the commentary, they hinted at a softer approach for the year ahead. Now, Chair Jerome Powell, he hinted that they expect the third quarter point reduction to the benchmark interest rate next year, even as some economists, they were betting on a more aggressive stance. So, Powell also said that the Fed is now seeing progress on the inflation across the three main core areas.
We are seeing, strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. Expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth has turned out to be very strong in the third quarter, is slowing. We're moving carefully. One of the things we're moving carefully about is that decision over, that assessment really over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table.
And after the Fed's forecast for rate cuts, Jeffrey Gundlach also expects the 10-year Treasury yield to continue to fall to the 3% range next year. In an interview, the Double Line Capital CEO said bonds will continue to rally, and if the 4% level is broken on the yields, then a fire alarm would go off relative to the economy. Projections released by the Fed showed the central bank would slash rates to a median 4.6% by the end of 2024. But he also believes that it's unlikely that the central bank would reduce borrowing cost by that much next year.
And even if the US may be banking on a soft landing, the picture is not so optimistic for the UK because the GDP contracted by 0.3% past October. And this dip is signaling a worrisome start to the final quarter of the year, raising concerns that the economy might not just be cooling as yet, but actually shrinking. And the decline that was largely led by a broad-based slowdown across sectors, the crucial service sector, the heart of the UK economy, that took a hit, as did the manufacturing sector. Now, consumers already squeezed by the soaring prices as well as the stagnant wages, they are cutting back on the spending, which only adds to the economic woes.
And Chancellor Olaf Scholz's three-party governing coalition has struck a deal on spending for 2024. It comes after a court ruling threw the government's finances into disarray and exposed deep rifts between the parties. The government is expected to save 17 billion euros in its core budget by ending climate-damaging subsidies and cost-cutting. He also added that the government was sticking to its goals, including supporting Ukraine.
And government ministers representing around 200 countries have agreed to a deal that calls for a transition away from the fossil fuels. And this is after a previous proposal was met with heated and widespread backlash. Let's go across to my colleague Bhavya Dua to understand the implications of this deal.
Right, so nearly 200 nations meeting in Dubai for COP28 on Wednesday agreed to transition away from fossil fuels for the first time ever, which is a key step for curbing greenhouse gas emissions on the planet. After 13 days of negotiations, the president of the UN-sponsored summit brokered a deal with its language to show the global forum is serious about checking the use of fossil fuels and addressing concerns of the OPEC, the group of the world's biggest oil producers. The agreement commits the nations to commit to reducing carbon emissions and take steps to prevent a possible global climate crisis. Let's peek into the significant takeaways from the COP28 Dubai talks. The first one is, of course, the historical fossil fuel agreement. The COP28 concluded with a landmark agreement among nearly 200 countries to begin moving away from global consumption of fossil fuels, but omits a reference to a phase-out. The second one being the climate finance. The UAE will contribute $30 billion to a new climate fund called Altera that would have the world's marquee investors as its partners. The fund seeks to raise $250 billion of investments by the end of this decade. The parties to COP also pledged $700 million in funding to help lower income countries cope with the loss and damage caused by the climate change. The next one is the cooling pledge. With rising global temperatures leading to demand for more air conditioners and other cooling electronic products, a new UN report launched on Tuesday at COP28 climate talks in Dubai lays out a pathway to cut emissions across the cooling sector worldwide. Over 60 countries signed up a so-called cooling pledge with commitments to reduce the climate impact of the cooling sector. The next one is the focus on renewable energy. Some 118 countries have agreed targets to triple renewable power generation capacity to 11,000 gigawatt and double energy efficiency in this decade. The last one is the methane reduction. Now 50 energy firms have pledged to reach near zero methane energy emissions by 2030 and submit a plan to meet those targets by 2025. A fund was also announced for methane abating projects in emerging markets and developing economies. The group of 50 firms also agreed to net zero greenhouse gas emissions.
Well, thanks, Bhavya, for that update. But with this, we're timed out on this segment. See you on the other side.
Right, welcome back to the show, and thank you for staying tuned in. And it's on that part of the show where we mark the Asian markets for you. Asian market looking pretty good. It's mostly rose, and it mirrored the Wall Street gains after the US Fed Reserve. They held the rate steady and also indicated cuts next year. Let me mark the ASX first. It's up around 1.6%, and that is quite good, and it's the outlier actually among all the Asian markets. If I look at the Australian unemployment rate, that is at its highest since May 2022. The Australia's unemployment rate rose to 3.9% in November, up from October's revised 3.8%, and it's the country's highest rate since May 2022. So despite that, we are seeing the ASX, it's up around 1.5%, and this is mainly coming in from the FOMC meet. Even the Australian interest rate market, that is pricing in 50 bips point of cuts in 2024, up from 25. So yes, that was on ASX. But moving on to Nikkei, that after seeing a string of gains, today we are seeing it in red, and it's around 0.4% lower. So that's on Nikkei. And Chinese yen also, it hit its 1 week high as dollar slumped on dovish Fed. So that was on Nikkei. But moving on Kospi, that's 1.4%, around 1.4% higher. It's in green. HSI is also now the highest at around 1.9. It's at 1.6% as we speak, and also Shanghai is looking quite decent. It's 5-10% higher. So that was on Asian markets, looking pretty good so let's see how it pans out for our market, because if I look at Nifty, it closed at around 20,926 level, a little shy of that 21,000 level. But if I look at GIFT Nifty, that is at 21,227. It indicates a gap up opening for our market actually. So let's look at how it pans out for our market, looking at a positive opening for our market based on the FOMC meet outcome, how the Asian market is looking, how the US market panned out, and also at our GIFT Nifty. Shreyansi.
Welcome back. Thank you so much for staying tuned in. Well, let's switch gears to news coming in from the aviation sector now. And SpiceJet has approved a fundraise worth 2,250 crore rupees, and this is via equity share and equity warrants. Now, we had an exclusive interaction with the company's CMD, Ajay Singh. Listen in to a slice of that conversation.
With this round of funding, we expect to come out of these problems and set ourselves on a growth path again.
Currently, what is the fleet size, and in terms of revival of the aircraft, in terms of the fleet or the aircraft that you are looking to get in from Boeing, can you share some more details on that?
We are flying 40 aircraft at the moment.
Okay.
We expect to enhance that significantly. We are working on plans, so I can't tell. Okay. I can't say exactly how many, but we will certainly try and double our fleet over the next 12 to 18 months. Now, Some of these are aircraft which are grounded, which we will be putting back into service. Some of these are aircraft that we will be taking on lease, and some of these are deliveries that we expect to get from OEMs. So we are quite confident that over the next 12 to 18 months, we will at least double where we are today.
Tough time that you have been going through, especially during the COVID period. But that was a time, and post the COVID period, you lost a significant market. You lost some routes, also the kind of problem that you're facing. So in terms of market share, how you plan to regain it? How you plan to...
Market share is a function of the number of aircraft that you're flying. As soon as we enhance the market, as soon as we enhance the fleet, you will see an increase in market share. So one needn't be overly concerned about market share. It comes back.
And that was an exclusive on SpiceJet. But moving on, Interglobe Aviation will be in focus because the management conducted their management meet. So let me go across to Somit, who tracks this company closely, to find out what are the key takeaways. Good morning, Somit. Somit, what are the key takeaways? What is the company talking on the growth outlook, the demand, as well as yields?
Well, if you see, the Indigo's top management met with Motilal Oswal, and what we are understanding is that the key commentaries that are coming in, firstly, is the fact that though air traffic was subdued when it comes to the month of October and November, but it has picked up, and management is confident that the demand, air traffic demand, has not peaked in India, and they're still expecting a strong growth going forward. They're saying India is one of the fastest growing aviation market in the world, and they're expecting around 1,100 passenger aircraft requirement by calendar year 2027 that will cater to the India's growing air traffic demand. And the key commentary here is that the air traffic has not peaked, which means that they must have seen a strong demand coming in the month of December. Along with this, another key commentary that has come in is the fact that yields are expected to be flat in Q3. Now, generally a flat yield could be taken as a negative commentary, but here it is positive because post the second quarter call, the company had clearly mentioned that they're seeing a decline in the yields in the month of October in high single digit. From there, if they have managed to keep the yields at a flat level, it's actually a positive commentary that has come in for Indigo, because they're also seeing that the yields have pretty much normalized post Diwali. So strong Q3 numbers could be expected from Indigo going forward. On the international traffic, they said that the international traffic has also slowed, but yields are expected to remain flat even there. And when it comes to their long-term plans, they aim to increase the international presence through strategic partnerships only. Currently, they have around 8 codeshare agreements. So similar more codeshare agreements can be expected from Indigo's side going forward. On engine issues, the company expects 35 more aircraft to be grounded from operations from January 2024, and Indigo has been working with Pratt & Whitney for the monetary compensations for this going forward.
Well, thanks, Amit, for that update. We'll definitely be keeping an eye on Indigo. So thanks for that update coming in. Well, Lisa, I have a question for you. Okay. So if a home is worth around 50 lakh as of today, how much will be the cost of that house by 2047?
Considering the inflation, maybe around catch 2 to 3 crore. I mean, it depends on the location as well.
Well, you're close, but the word coming in from the management...
What's the price?
Yeah, it's going to be 3.5 crores, and that is the word coming in from Abhishek Lodha, who's the CEO of the Lodha Group, and he gave us his commentary in our interaction earlier. Listen in to a slice of that conversation.
What we would love to see is that home prices rise around or just below wage growth, so that affordability keeps improving, but at the same time, people who own homes feel richer. I mean, I'll give you a statistic, and it's quite stunning. A family which would buy a home today, 50 lakh rupee home today, that home would be worth 3.5 crores in 2047. So when our Honorable Prime Minister says that 2047 is the year India becomes kind of a developed nation, you can imagine that for a middle-class household to feel 3 crore rupees richer only because of their house, then everything else that they earn can be used for other purposes. So the home is a huge creator of wealth for the middle class or anybody who owns a home. And therefore, it's very, very important that home prices go up. They have to go up modestly, but they have to go up.
But so we've addressed the big picture, which everybody wants to know from India's biggest real estate developer, residential real estate developer, outlook cycle and outlook on prices. Now let's focus on shareholders. the shareholders are also happy lot. Post-COVID, magical things have happened to the real estate stocks and your stock also. What has changed post-COVID for you?
I think what's happened is a culmination of a lot of pain that the sector went through between 2012 and 2020. We had very good regulations like RERA. We had other things like demonetization, GST, the insolvency and bankruptcy code affecting the sector. We also had a large number of the non-banking financial companies, which you cover closely, who took large real estate exposures, lent to developers who were not meant to be in this business at the scale that they were being lent to, and that created oversupply. When ILNFS imploded at the end of 2018, the correction process started then, not because of COVID. And now you have a situation where consumers are aware that they should only buy from the best brands. They want quality. They also want certainty and trust. And that in turn has led to the situation where you see that the stock prices of the top developers are doing well, because the people or stock investors realize that not only is India going from low income to mid income, not only is the quantum of housing demand huge and unlikely to be met anytime soon, but also that the consumer preference has dramatically shifted to very, very select brands or players. And just like in any branded business, you will have those players getting the majority of the demand and therefore the profitability.
So that was the CEO at work with Abhishek Lodha talking about the housing trends going forward. But let's shift focus on the ever-evolving landscape of artificial intelligence. The companies worldwide, they are recognizing the critical interplay between the reputation, ethics, as well as responsible AI practices. Now, amidst this, a call for balanced regulations echoes, offering essential guidelines. My colleague Sumita Karir has an exclusive conversation with Sanjeev Bikhchandani, the co-founder of InfoEdge. Listen in.
We should play to our strengths. See, we are kind of short of the capital and the compute power required to develop LLMs from scratch. But I would not, see, all the publicity may have been hogged by OpenAI and by Google, but the truth is there are more than a dozen other LLMs out there. Right? We can exploit any one of them. We can partner with any one of them. What we at InfoEdge are doing is that we are not going with any public, LLMs. We are going with vertical LLMs where we don't have to share data outside. So because we realize our data is precious, and we therefore want to ensure that others don't have rights on it.
Now I want to ask you about the startup ecosystem. This has been a very tough year. We're almost, at the fag end of 2023. What does 2024 really look like for you? Is it going to be similar to what 2023 has seen? Barely 2 unicorns, a funding crunch, 75% funding is down in startups. And so starting specifically about InfoEdge, now Naukri's vertical growth has slowed due to slowdown in IT hiring. I mean, you've seen multiple cycles. How long do you expect it to last? Is it structural or transient?
The truth is we will find out as we go along.
Okay.
Right? So we can't really predict. But in the past, growth has always come back. Right? IT is too important and too central to the global economy for it to be in the doldrums for very long.
Absolutely.
We are hoping maybe in 2-3 quarters, but we can't say for sure.
And so will you be able to give some color on, the kind of cash on your balance sheets that there is?
Well, it's upwards of 3,000 crores when I last checked. But we have always, kept more cash than most others think which we need to keep. And there's a very simple reason for that. We believe extra cash is good because it helps us take the right decisions in times of crisis.
So what about your portfolio companies? Are you looking at increasing your stake? What are your plans?
Well, so we've got, I think, about 70 or 80 or 90 companies in our portfolio over the last 15 years. We play it by ear, company by company, case by case. If a company needs the money, deserves it, we might go in. If the company perhaps does not deserve it, we have to sometimes take a tough call.
Right.
But we also have a fiduciary responsibility to our shareholders to safeguard their money well. So it's case by case.
Well, from one exclusive to another then, IKEA is setting sights on Delhi, unveiling plans for 2 major projects within a year. The first store will be Delhi NCR, at Delhi NCR will be promising a groundbreaking retail experience. My colleague Sumita Karir also had an exclusive conversation with Susan Palvarar, who's the CEO at IKEA India. Listen in.
So these 3 markets, Hyderabad, Bangalore and Mumbai with surroundings, are of course not fully expanded, so there will be more, but the big next market is Delhi. So we are preparing 2 big projects and online in a bit more than a year. So that will be a very exciting opening of a market, and I know many have been waiting and we are waiting too. Then we look for some other cities and markets as well. The plans are in the making, so I will come back at the later stage to share more details.
Right. So I think there was an intercity war that sort of broke out, like, Mumbaikars, of course, were, happy that IKEA first came to them, and, Delhi NCR people, we've been waiting with bated breath. So can you give some color, some details or some tentative timeline on, how soon?
Yeah. So why the Delhi? It's to wait a little bit longer is that we do some unique projects for the first time in India. Okay. So we do meeting places, which is shopping centers with a bigger meaning, with an integrated IKEA store. Mm-hmm. These are much bigger projects, and that's why it takes a little bit more time. Okay.
So that was on IKEA Outlook, but moving on, when prices of everything is going up, rising inflation is a concern for the government. It's good news for the insurance holders because term insurance rates are falling. We at ET Now, we compared the premium of term plans over the last 3 years and found that the post-COVID rates are falling. Now, Anurag Shah has details on this. Anurag Shah, you are saying that the premiums will fall more as the reinsurance rates are softening. What are you gathering from this, and what will be the impact on the insurance companies?
So going ahead, we can see that term insurance rates may go down, and the reason behind this is that the reinsurance companies has not increased rate for term insurance portfolio in last 2 years, and as per our sources, in coming time we may see the rates of reinsurance also going down. So companies may pass on that rate cut to customers. And even if we compare, we have seen that after the COVID in 2021, there was a hike of 20 to 30% in term insurance premium. But post that hike, we have recently compared that companies like ICICI Prudential, SDFC Life, they have reduced their premium rate by 5 to 7% as comparison to the COVID hike, and we may see that going ahead there may be a more reduction in term insurance premium, and it will depend on the size and volume of the insurance company. And we talk about the LIC. So in LIC from 2019 to 2022, they have not increased term insurance premium during the COVID time also. So LIC rates are little higher as compared to post-COVID time, but we compare the other 2 major players like SDFC Life, ICICI Pru. So in comparison to December 2021 to December 2023, there is a reduction in term insurance premium, and it's likely to see that going ahead also there may be some more reduction due to the reduction in reinsurance rates.
Well, thanks, Anurag. So we'll definitely be keeping an eye on that New Year bonus, potential New Year bonus coming in. But with this, we're timed out on this segment. See you on the other side.
Welcome back to the show, and we are on that part of the show where we talk sector as well as stock specific, and also keep you ready for the cues that you have to watch for in the upcoming trading session. But let's start with the stocks that you have to keep an eye on, and we have Ashish to take us through that list. Good morning, Ashish. What are the stocks on your radar?
Well, yes, first up, let's talk about Fusion Micro, where a big block deal is expected to happen today. Sources say that Warburg Pincus may sell about 9.2% stake in the company. As compared to yesterday's closing market price, this deal can happen at a 5% discount. So on account of this block deal, which is expected to happen today, keep an eye out on this counter. Also look out for South Indian Bank in today's trading session. We have agency-based news which says that certain fraudulent acts were committed in one of the branches by an employee of the bank. Unauthorized transactions were done in a customer's account, and a flash report has been filed by the bank to RBI on the 13th of December. Perhaps some selling pressure could be seen on this counter as well. Meanwhile, NBCC will be in focus on the back of an order win where the company informed the exchanges that they won an order worth about 1,500 crores from NCDC for infra construction. Keep an eye out on this counter as well. Also, let's talk about Vedanta, where the board of directors will be meeting on the 18th of December to consider second interim dividend for this financial year. Uno Minda, meanwhile, has commissioned its new automotive seating systems plant under its subsidiary in Ahmedabad, Gujarat. The company said that it has already received orders from OEMs for this particular parts, so keep an eye out on this counter as well. Meanwhile, Signature Global, they've acquired land parcel measuring about 25.2 acres situated in Haryana, and the company also says that it has the development potential of approximately 5.5 million square feet. So on account of this acquisition that the company has done, keep an eye out on Signature Global as well.
Absolutely, Ashesha. So we'll definitely be keeping an eye out on all of those counters. But JSPL is also in focus, and they conducted their management meet. What are the key takeaways? What are they penciling in for the third quarter? What are you seeing? How are you seeing this?
Well, yes, so Phillip Capital met with the management of JSPL, and on the back of that, they've come out with this note. First up, they've spoken about third quarter, where they say that the third quarter is expected to be strong. Volumes are expected to be on the weaker side, but margins could expand on a sequential basis due to higher steel prices, and perhaps EBITDA per ton could also see a sequential improvement in the third quarter. As far as capex plans are concerned, they say major steel volume growth is not expected to come in the near term. We will see steel volume growth only from FY26 onwards. As far as medium term specs expansion is concerned, they say EBITDA per ton could expand in the medium term. They've undertaken several cost rationalization measures such as coal and iron ore mine, which will start contributing in a staggered manner from the fourth quarter of FY24, and hence they are expecting EBITDA per ton expansion in the medium term. Phillip Capital, meanwhile, says that given their heavy capex, they expect debt to peak out in FY25 or in the first half of FY26, but will remain under 1.5 times of EBITDA. They also say that quicker commissioning of coal mine has the ability to increase EBITDA of the company by as much as 10 to 15% by FY25 and 26. So yes, in the near term, third quarter is expected to be strong both on EBITDA margin spreads front, but in the medium term, EBITDA is expected to expand on account of volume growth and cost rationalization measures that the company has undertaken.
Right, so that's on JSPL, which will be in focus today on the back of the management meet and the key takeaways shared by Ashesha. Thank you for that. But Inox India, focusing on the primary market, Inox India IPO will open for subscription today and it will close on December 18th. Now the issue, that's completely an offer for sale of around 2.2 crore shares with a face value of around 2 rupees per share. Now talking about the company details a bit, the OFS that, as I said, it's around 2.2 crore equity shares. The price that is at 627 to 660 per share. So the issue size that comes to 1,386 to 1,459 crore. The post-issue market cap that will be in the range of 5,691 to 5,990 crore. Now talking about the financials a bit. Between FY21 to FY23, this company has seen good growth. It was at 594 crore in FY21 and now it's at 966 crore. But the margin has seen quite a contraction because it was at 24.6% in FY21 and it has contracted to 22.6%. Talking about the PAT, that has seen a steady rise from 96 crore to 152 crore. The ROC has remained largely in range of 35 to 36%. Order book also looks strong and mainly it's from the industrial gas segment. They have a major proportion at around 52.8%. The LNG segment that is at 25.2%. The cryo scientific that is at 22%. So that's largely their order book. Talking about the divisions, it is in these three segments as well. It is one of the largest exporter of cryogenic equipments in India, having around 3 manufacturing facilities catering to over 1,200 domestic as well as 220 international customers. The order book on as on September 30th, that stood at 547 crore, and that was for the industrial gas segment. And for LNG, it was 260 crore, and for cryo scientific, it was 228 crore. So yes, that's largely on the new kid on the block, that's Inox India for you. So yes, keep an eye on Inox India for the subscription. So yes, Shreyansi, that was on Inox India.
Absolutely. So we'll definitely be keeping an eye on Inox India. But which are the brokerage notes that will be in focus this morning? Gaurav is standing by with that list. Gaurav?
Yeah, Shreyansi. So on back of the brokerage notes, we have two major sectors and we have update on those sectors. So the first sector that we will be talking about is life insurance. Now we all know that we have seen some kind of rally in life insurance, and now Investec has come up where they have upgraded target price for some of the companies under their coverages. So the first name to take as is HDFC Life, where they have hiked the target price to 825 rupees. For SBI Life, they have hiked the target price to 1,700 rupees. For Max Life, they have hiked the target price to 1,350 rupees. For LIC also, they have hiked the target price to 875 rupees while downgrading the rating to hold. And for ICICI Pru Life, however, they have downgraded the rating to hold, and they have also cut the target price to 590 rupees. So why this major move is coming up is basically they believe that life insurance sector has underperformed the market in the last 5 years, and the reason being that the sector has high expectations. The investors had high expectations from the sector, and sector also shown some kind of a high valuation ratio. But going ahead, life insurance is in a good shape right now. They believe that they have diversified product portfolio, they have broadened the distribution network, and they also believe that we have better product proposition right now, and that is why they have upgraded the target price for some of the companies, and the few to name as HDFC Life, SBI Life and Max Life. The next update we have is from the power sector, where Bernstein believes that we have some kind of tight situation in the demand supply in the power sector, and in this situation merchant power plant is going to outshine, and it is the only way to get supernormal returns from the power sector. Now, why they believe is that basically, if we see the past in 2009 and 2013, the same situation had arisen, and that time JSPL had shown some kind of enormous returns, and on back of this, they believe that now also when we have power supply shortage, the merchant power plants will perform. And in this segment, they have highlighted two names for us. One is Adani Power and second is JSPL again. So they believe that Adani Power has acquired some kind of distressed assets in the last 5 to 6 years, which is yielding in a good returns in terms of merchant capacity for them. And they also believe that Jindal Power, which is part of JSPL, has registered a gross margin of around 1,000 crore in 1H FY24. So all in all, it seems that they are being bullish on this sector, and we also saw that market is also bullish on this sector. So let's keep an eye on Adani Power as well as JSPL as well.
Well, absolutely. So we'll keep an eye on all of those counters. But with this, it's curtains down on this edition of Market Cafe. From me, Shreyansi Singh, Lisa Fernandez, and the entire team that put this show together. Thank you so much for watching. The market takes the action forward.